consider 1 year, right? In some cases, it can be like 13 months or 14 months or 16 months, but normally 99% the accounting period is for 1 year. Around 60% of large companies use calendar year from January 1st through December 31st. 1 year starts from January 1st through December 31st. But other companies, they can be from June to June, March to March next month. So it depends. But majority, they measure their performance from the start of the year and at the end of the year, because at the start of the year you still have new year, so that you can give bonuses. So it's very easy for you to give bonuses to start a new year, happy year, starting and ending. You have a Christmas and all the stuff, so it's going to be happy ending. So it basically coincides with your employee satisfaction and other subjects as well. So that's why most companies, they measure their performance from January 1st to 31st of December. So a fiscal year may end on date other than December. Yes, I told you June to June. It depends. And companies also prepare interim reports. During the period, they can also make monthly reports, quarterly reports, semi-annual report. This is not required by the law, but you can judge your own performance, or you can send the performance signals. Okay, our company is going good, right? But at least one time you need to publish it to the outside world. Yearly performance, 1 year performance. That is required. Fiscal or accounting period performance. That's it. Rest of the things can be for internal use, or can be to create a market signals. Okay, we are going good this year, we will be having this much profit, and our shareholders, please be confident. It's like that. There are other stuffs as well, right? To give the positive signal to the market. Okay, our share price is very strong, and it is going to be increased in future because we are doing good. Look at our financials, monthly financials, quarterly financials, semi-annual financials. Okay, then our second learning objective is apply the revenue and expense recognition principles. So can anyone tell me what is revenue and expense recognition? We already talked about in our first lecture as well, and in the second lecture as well. Revenue and expense recognition. Lota, can you? Fabian?
Is it when you have expenses, you have to recognize like any revenue that like occurs at the same time?
Exactly. Expense and revenue. Just look at this word, recognition. See, you recognize or you record the revenue when it happens. That's it. And when expense happens, that's it. Maybe the payment is later. For example, salary, 30-day salary occurred, you record it on 30th. But maybe you pay after 5 days or 4 days, right? But you record it on 30th. That is expense recognition. Revenue, okay, when you receive the order, sale happens, okay, happen. That's it. But when you receive the cash is different. Maybe you receive cash after 3 months. So this is the core of accrual accounting. So revenue principle deals with two issues: when to record revenue and what is the amount of revenue to be recorded. So revenue is recognized when the business transferred promised goods or services to a customer in an amount that reflects the cash or fair market value of other consideration that the entity expects to receive in exchange for the goods or services. So what I was saying, whenever you receive the order, you recognize sale happened. No. Sale happens when you transfer the goods from your company premises. You receive the order, so that is called sales order. Sales is not complete. So when you, okay, the customer orders 1,000 pieces. So when you ship the 1,000 pieces, as soon as the ownership transfers from company to other parties, like transportation company is different, okay, and then on the customer, okay, for example, customer said I will be paying the transportation charges. So ownership transfer from or at the company's gate. Whenever the goods, finished goods are done and handed over to some delivery services, sale happened because ownership is now transferred, right? So at what amount? By the way, why we write it down what amount? Of course, whenever there is a sale order, there is amount written. And then why we are talking about this second issue? Because in some businesses, there is a barter system as well. Or the company may be the subsidiary company, right? Or maybe the company belongs to one of the employee or CEO's friend, or maybe wife, or maybe brother company. So is it illegal for a company to buy raw material from CEO's wife companies or CEO brother company? There is a conflict of interest, but that doesn't mean that you cannot buy. You buy if your wife's CEO's wife company ensures the competitive price plus the maintained quality. Or whenever you are in this situation, you have a company, your own company, your subsidiary is producing the raw material and selling to you. We call this vertical integration. Your company is making the raw material as well and converting that raw material into finished goods. So maybe the raw material company is in Japan, and that raw material is sent to the China, and they assemble it. For example, Toyota company, they make engines in Japan. They send the engines to the Toyota China, and they assemble, and then they make car. So final goods are going to be finished in Toyota China. The raw material is provided by Toyota Japan. So in this case, how much value you need to write it down. Fair market value. You cannot say that, okay, since we have a very, we have a relationship, so whatsoever, if in the market one engine costs $10,000, but due to your inefficiency or your efficiency, for example, it cost you 15,000, and you cannot write 15,000 like that. Then you need to outsource that department to somebody else, right? Or if it's a barter system, they provide you engine and you provide them tires. So that doesn't mean in order to, show, we call this cooking the books. We'll talk about that, I think, in next coming slide. Cooking the books means you are changing the values. And maybe you say that, okay, we sell our goods to this company. Actually, the value was 10,000, but you recorded to increase your profitability as 15,000. Because who is going to check? Because we have arrangement, we can do whatever we want. Because this is our sister company or this is our subsidiary company. So that's why a fair market value should be considered. So if you can buy the same amount of same quality and same quantity and quality of this goods from somebody else, it costs you 10,000. So you cannot write 15,000 because it's a barter system. No, right? So that's why we have this kind of stuff, right?
How can you say verifies the price of the market? Because the price change every time and everywhere, actually.
So you can just log on to the Google and you can say that, okay, what is the price of iron, raw iron in the market today? Because your raw iron arrived to your company from your subsidiary on 12th of October, right?
Mhm.
You don't have any kind of cash consideration. It's just coming to your, they don't talk about the money from you, but you need to write it down. So you go to the Google, what is the amount of per ton of raw material of iron ore? And you go, okay, this is like $10,000. Okay, you write it down, $10,000. That's it. You cannot write it down. Okay, the iron ore is coming to your company on 12th, and then you write it down the value on 15th of October. No, on the same date, right? Okay, this is the global view. Just pause the video and read it by yourself. This is just for your know-how. So those who are watching this lecture, please pause the video and try to read it by yourself. So there are two boards that I talked about, FASB and IASB. One is for GAAP and one is for the non-GAAP countries. So they could just talk just read out that when we are trying to record the sale, what are the difference between these two standards. Okay, here. So when you apply the revenue and expense recognition principles in situation one, here we go. So we have two situations that provide guidance on when to record revenue on the Starbucks Corporation. So revenue is not going to be recorded when you see the customer came to Starbucks and it says, I plan to start drinking Starbucks drinks. Great. We will welcome you as a customer. The ownership transfer to the customer, it means no sale occurred. So that's why sale order is not sales, right? Because customer still has the power to cancel that order. So when order is confirmed, then you can say that sale is is done, and you need time for 3 days to make the product or ship the product or whatsoever. And after 3 days, whenever your responsibility transfer to the customer or your ownership transfer to the customer, then sale happens. Here we go. Now, when you record the revenue, customer says, a latte please. And the Starbucks said, I appreciate your business here with the latte. See, the latte is, ownership is going to be transferred and then they record it. Of course, you see on the Starbucks, okay, you pay for your latte and then you wait in a line, right? And you receive that latte, right? But they record the transaction 2 or 3 minutes before. But this is a very minimal time. You can just ignore that, right? So that is just their cash collection techniques or whatsoever. But technically, the sale occurred when you received the latte. But in real sense, what happened? You pay at the point of sale and then you wait for your turn and then you receive the latte after 10 minutes break whatsoever, right? So that just happened. This is very minimal time, so you can just ignore that. But after 2 days or 3 days, if you are doing that, then that is a serious offense. Expense recognition, it also involves two